Hey everybody, my name is Doug Pardick. I'm a financial planner located here in Littleton, Colorado with Talon Wealth Strategies. And I shoot these videos about the market once a quarter, but this is a big one. We just finished off 2019. The stock market had wonderful returns. We'll talk about that. And then we'll take a look at 2020 and what we think is going to happen this year. You know, no crystal ball, but we do have some expectations based on fundamentals. And I definitely want to share that with you. So financial planning is very much like American football. And so what do I mean by that? A good football team is going to take risks early on in the game. So first quarter through the third quarter, you're going to see more passes down the field trying to stretch the defense. You might see some trick plays, but teams are willing to take risks and diversify their playbook in order to rack up points. And as they get into the fourth quarter and they get a sizable lead, that good team is going to change the strategy. So strategies in the beginning of the game are very different than the ones at the end of the game. They're going to get more conservative. They're going to want to protect the football. They're not going to want to take as much risk. Same thing goes with your financial plan. How you invest completely depends on where you're at in the game. If you're a young investor, you're going to invest very differently than an investor coming up on retirement or being in retirement. Totally makes sense. So as a financial planner, that's what I help my clients do. We build retirement plans totally based on your ability to take risk and where are you in the game of your financial plan. So let's get to it. 2020 is going to be possibly a good year, but let's take a look back and look at the market returns. Here's a really interesting chart showing you the returns in the S&P 500 going back to 1996. You'll see that there's a long period of time there where the market's flat. It's just going up and down, and it's flat. You're ending up right where you started 10 years earlier. So that's not good for people that are trying to retire and having that kind of a market. Fortunately, we've had a really good long period of market returns. Finally, in 2013, late 2012, early 2013, the stock market, the S&P, finally got back to even, and off to the races it goes. In the last 10 years, we are up about 250%. So investors that had exposure to stock market, man, you did very, very well over the last 10 years. Here, let's look back even further, and you'll see that over time, the stock market has cycles. It goes through a time where it's flat, and those flat periods can be 10 years or 15 years. And then we have these nice, long, what we call secular bull markets, where the stock market has incredible gains, a lot of wealth is made, but then it gets interrupted again by a period of a flat market, and then back off to the races again. So look at the upper right-hand chart. We could be 10 years in on this new secular bull market. If this is true, if the patterns hold up, we could have another 10 years in this secular bull market. Yes, we could have bear markets in between, and a bear market is when the stock market drops 20% and stays down for a little while and then recovers and back off to the races it goes. So we could see a recession in the next couple of years. Right now, the chances are pretty low. It could happen, but wow, we could be in a bull market that could last till 2030, 2031. So we'll see, but it's good to invest some of your money in case we do have this nice long bull market. So let's get back to the near term. The last 23 months, if you look at this chart, the green line shows from the market peak in February of 2018 to the recent highs, the stock market has increased. But when you measure it, it's only an increase of 12.5%. If you annualize that, that's a 6.5% rate of return. Not too flashy, but it's better to be up than down. But again, it has not increased that much since early 2018. And we had this huge drop-off, a 20% drop-off in the stock market the fourth quarter of 2018. And when the market goes down that much, a lot of investors panic and flee out of stocks. Oh my gosh, the bear market is finally here. The party's over. Let's get out of stocks. Let's go to cash. Let's go to something more conservative. But then if you do that, you time the market, you missed out on this nice rebound. And we had this nice, what we call a V-shaped recovery. And within about 4 to 5 months, early May of 2019, the market had recovered and we had these really good gains coming out of the gate in 2019. So by the end of the year, the stock market did really good returns for 2019, but a lot of it was just the rebound from the big loss we had the year before. So when you sell low like that, you start getting lower returns. Selling low and then buying back in higher, you start to lower your returns. This chart shows on the far right, the average investor over the last 20 years averaged only 1.9%. So we humans get emotional and we make mistakes. We sell when we shouldn't sell and we buy back in when we shouldn't buy back in. And it makes us bad investors. And it's hard to reach your long-term goals when you're investing that way. So hiring a financial advisor is going to help you stick to the plan and improve your results over time. So do not act like the average investor. So why have the last 10 years been so good for the U.S. economy? Why are we so resilient? Innovation, productivity, and creativity. That's what it's all about. The U.S. Is really good at finding people that can do that, can increase technology, increase artificial intelligence, increase the productivity at the corporation level. And the U.S. worker is a hard worker. When you mix this all together, the U.S. economy overall is very resilient. And you see in this chart here, for example, U.S. oil production going from 1969 to 2009 was going down, down, down. It looked like it was just going to keep going down forever. But there was a miraculous rebound. It's all because of innovation and new technologies. We are now becoming a major exporter of oil. And when companies like Apple and Amazon and Microsoft and all those companies that are really good at innovating and creating new technologies and new ways to increase productivity but lower expenses, this is very good for corporate earnings. So this chart shows that in 2020, we expect corporate earnings to increase 8 to 12% over last year. This is really good for corporate stock prices or the U.S. stock prices. So as earnings go up, stock prices will eventually follow. So this is a good sign. Another big part of the U.S. economy is the consumer. About 20% of our GDP is driven by the spending of the U.S. consumer. So are they healthy? Are they unhealthy? Let's look at some of the facts. So net worth by household is at historic highs. So this is a good sign for U.S. consumers. Consumers' debt. So you take the personal income for consumers and how much of that is going to pay off debt, and it's at historic lows. Only 9.7% of U.S. income is going towards debt payments. So that's a really good sign too. And because the consumers are healthy, because corporate America earnings look like they're going to be increasing over the course of 2020, this is a good sign for the U.S. economy. There's always some risks out there, and we want to take a look at those. But overall, we do see the U.S. economy growing slowly, but should avoid recession. Last year, the economy grew at around 2.3%. We think that's going to slow down a little bit more, but it's going to stay positive. So we should avoid a recession. Economies overseas. You look at Europe, you look at Asia. How are they doing? And actually, as the trade tensions ease up between the U.S. and China, this has a rippling effect to economies throughout the world. And one place that we may increase our investing in our growth portfolios would be to emerging markets. Their economies are growing faster than the U.S. economy. So there's an opportunity there overseas, but some places we're going to be avoiding until we see some better improvements in some of the dynamics, for example, in the European countries. We do see modest gains in the U.S. stock market in 2020. If we get 8 to 10% returns, that's about what we expect. But while we do that, while we get there, we do see potential for volatility, especially because it's an election year. There is going to be more headlines. There's going to be emotions on both sides of the political spectrum, and this can create temporary volatility in the stock market. But again, with earnings and consumers being so healthy, this gives us more reason to believe that we should have positive returns by the end of the year. Here's some of the risks that we're looking at in 2020. In the election, there is risk there if we do move very far to the left on the progressive side with a new president, with new Senate. This could be a shock to the financial system. Long term, we'll see what happens, but short term, this could create a little bit of a panic and a sell-off, but it's really hard to predict that and time it. So my best advice to you is don't play politics with your portfolio. Don't focus on all the noise coming out of Fox News or CNBC or CNN. Focus on the math. Right now, we see earnings doing well. We see corporations being healthy and innovative, increasing artificial intelligence to make their businesses run more efficiently, and productivity goes up and earnings go up. So looking at the math, there's more reason here to believe in a positive return than a negative return in the stock markets. Now, we do believe that now is a prudent time. If you're coming up in your retirement or you're in retirement, now is a good time. Sell high and start moving some of those gains into what I call a bucket one preservation plus type of portfolio. No stock market risk. We're going to have very low volatility. We're targeting a return of around 2 to 4%. And that money is there. It's insurance. So if the stock market does take a big plunge and there is a recession with the economy, you do want some money parked in a preservation type of portfolio, but you want to try to get some returns and keep up with inflation. And we do have a strategy for that. So feel free to call me. I'll share with you how we invest in that preservation portfolio and how it's designed to avoid volatility risk. But that's it for now. And we'll be doing another video each month. So check out my website, follow me on Facebook, on LinkedIn, and we'll be sending out videos once a month and doing a more of a market outlook every quarter. So I'm here to help. Feel free to call me, set up an appointment if you'd like to come in to talk about any of your goals or any of the content that I've covered here. But have a wonderful 2020 and stay tuned. Have a good one.